Welcome to TradeTheNBI.com. This is John's report. It's for June the 30th, and we're going to end the month, and, well, things are not looking so great to start out here. None of this is a surprise. We saw this with the declining magenta, where red had been in the lead. It was just a matter of waiting for the beginning of white to pop up, and we saw that happen as we were approaching that 38%, and it became pretty clear where things were going. If I update roughly where this is going to put us, minus 20% for the year if we're anywhere near this level when we close out the month. But again, this is all a realization when the consumer confidence numbers came through, and you had so many economists who weren't predicting any recession or anything even close to it until sometime next year. This is where I always say economists underestimate the cascade effect of opinion and viewpoint, and I posted on our Skype chat in that indications where, you know, consumers, 83% were talking about cutting back and things like that, and that's the main driver of the U.S. economy. And when that happens, that becomes a quick, well, I would say cascading event, exactly as it points out, because it just means that people freeze what they're doing, whether it's travel, expansion plans, other things, and this exacerbates itself into business decisions too. Usually on the corporate side, it's a little bit slower to develop, but when it does and they realize it, it's too late, and that's when you start to see, well, as we see in some areas already, the rescinding of new offers for employment and things like that, as well as then you start to get your increase in claims and layoffs, and that comes a little bit later. So these are all the things that we've been talking about as they would build, and it's just becoming more of a focal point. And of course, you know, a lot of them still don't think that there's anything negative really happening, but we haven't even begun the real inflationary cycle of things yet. And they're already talking about, you know, when the Fed's going to stop raising rates and go to quantitative easing again. And it's just premature talk when you haven't even gotten inflation under control, because we continue to look at the situation developing in Europe and how quickly it's starting to decay. And you can see here, clean drop in the euro, and we're getting back into that danger zone again. The central bank's going to have to step in, or it's going to get ugly. But there's no getting around the realities that are taking place there with the energy. Now it's causing business to have to either shutter or just postpone any production because the costs are too high. And that has a real effect. And then you throw in the Ukraine war and the artificial sanctions situation, and you've just exacerbated a bad situation and made it far worse. It is all pretty much self-inflicted at this stage. Of course, like we talked about, you know, gold was suffering some of this because of the bifurcation, so you really don't have a true market condition in that setup, but it's going to suffer when the market is down like that. That's a typical reaction. But again, oil is still over that 100 marker, so you're not seeing any abatement in what's going to be elevated costs. And you know, they're all talking about how everything's going to be discounted. Well, you're not going to get any discounts in oil. You're not going to get any discounts in food. So those relative expenses are beginning to really eat away at the consumer. And that has a profound impact, and it's going to be seen tangentially in real estate and all these other things later on. And we've been seeing the signs of this starting to build, and it's just a question of whether the market realized it. You know, my thought was that they would try and push things up towards the end of the year, and that they're not doing that at this particular stage is problematic. I mean, you still have a lot of money out there that has to go somewhere, and you can see it pops back into treasuries under weakness, and that lowers the yield some, but it's an indication that people are looking more for safety. But this isn't really much safety. You're just talking about guaranteeing yourself a fixed loss without losing capital. Whereas within the market, you've got a little bit more of a concern. And this is also a real situation, because now Bitcoin under 18, well, under 20, and under 19 at this particular moment. But, you know, that's also a secondary factor. You've lost this edge of free excess profits that people have been floating on with their crypto, and those who stayed around too long in it certainly have been battered quite a bit. And anyone, well, you can go back and we can look at the daily of it. it's been quite some time since we've seen this level. I mean, and that is critical, meaning that everybody involved in playing long positions within that upside down. And so again, there's a scarcity effect that adds to. From a 50K standpoint, breakdown every time we pivot with that under 25 level becomes pretty evident to us. We saw this developing yesterday. If we could turn to our 5K, things were pretty mixed, but we had profound, dips that were going in, and everything was gravitating around that 38-23 range that had a series of positive extremes that it began right here. And then every time we popped up with them and began new cycles, it was right around in that area, so it kept filling back to it. We had that secondary one down here at the 96. It was an alternative range, and as they got close to it, they kept fighting it back up. But literally every time we got on the parity or plus side of the 23, we were fighting back to it. And it just became a series of nice opportunities to short every one of those. And right as the end of the day, beautiful NBI white spike, just a matter of waiting for that pivot lower for the magenta. Started again here, and then boom, right as the post-market started. And that's led to what we're seeing right now. And filling in all these other previous algo levels and pretty much kind of supporting around them and that. So those are the new gravitation elements. Very much in line with what we expect. I would still think that 36 50-ish range where we were before is kind of a major importance in between this range, because the expectation was things were holding at a positive economic zone, you'd be somewhere in that 38 to, well, really on that low side, the 36, and up to as much as 41, 42, but 100 for the ES. And if this continues to show up with additional confirmation in payrolls as well as in unemployment numbers, we could see that tested. And then we're talking about potentially moving to the lower end of ranges, which is getting down to the 2800 ES. So going to be an interesting July. Get ready for it. Of course, we have the 4th coming up, so it's going to be a holiday. So there can be some interesting trades coming up. We want to be ready for that. Indicators will be coming out for the new month, so we'll be ready for Friday's action. But quite a bit going on. As always, though, we'll continue to talk about it on the Skype chat. Trade well. We'll talk again later.